Hey everybody, it's Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 6, 2024. Hey, how's it going? I hope you're doing well. I appreciate you coming by and watching my weekend review podcast. The format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frames and on the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the setup was, and then most importantly, we're going to talk about how I am going to manage the trade going forward, whether it goes my way or against me. You know, we have no control over it. After we go ahead and get in a position, we have no control over what it's going to do, but we have to have a plan. We have to have a process. We have to know exactly what we're going to do regardless of what the market does to us. And it's important that you come up with a plan, that you're patient, you wait for an entry, and that you have a good risk to reward ratio. You know where your stops are, you know where you're going to exit, you know where you're going to take partial profits, but you have to have a plan. So I hope this is going to be helpful for you. I hope you're going to learn something from it. It's going to be valuable. And if you do find something of value today, I really would appreciate it if you would hit the thumbs up button. Helps out the channel a lot. After we take a look at at my trades, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create that plan I was talking about, but then to follow the plan. That's really the most important thing. You can have a great plan, but if you don't follow it, what good is it? After that, I have gone down through my watch list, both on the daily time frames and the weekly time frames, and I have identified some decent potential trades next week. They're not where they need to be yet, but if they get there, then I will definitely consider taking the trade. It's important in trading that you look at the charts and identify, if it goes down 2% more or 3% more or whatever, and if it gets down to this level, then we have a confluence of signals or a confluence of levels that will act as some type of support. So I always like to do this on Friday nights. I go through my watch list for the next week and I just identify and say, it's not there yet, but if it got to this level, this would make sense and I would consider taking the trade. So that's what we're going to do today. Have a lot of trades this week that we're going to go through, and also a lot of different types of setup, not just one particular types, but really a variety of the different type of trading strategies that I use. So it's good. So we can kind of cover a lot of different strategies, and it's important that you have different strategies, because if you're confined to just one strategy or relegated to one strategy, that may work great when that particular setup happens, but the market goes up, it goes down, and so it's good to have different tools in your tool belt, I guess is what I'm saying. So hang tight. I'm going to run the U.S. legal disclaimer and then we'll get started.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get going. Let's start off on the dailies with Intel. Okay, you see this green box here. What is this? Well, to me, in the way I trade, this is what is called an order block. And this is an area that I would look to buy. And I did. But the reason why is here we have a low over here. We have a lower low here. We have a big move up that takes out this high. Now we've changed to a bullish market structure. So when you're in a bullish market structure, you should look to buy dips. And this was the lowest close here before the market structure change. And so the high and the low of this bar is what is the bullish order block. So it did come down into it. You can see that the price did hold this level. Now you can go ahead and just get in when you get to this bullish order block, but I was looking for a signal, the tactical signal to actually get me in. And this happened here on the 31st of May when we had a V1. Now a V1 consists of two bars, bar 1, bar 2. Bar 2 needs to go under bar 1's low and then go above bar 1's close. So when that happened, I did get long here at $30.29. Now, as soon as I enter a trade, I always place two stops. First of all, I place an emergency stop, and it's very easy. I place the emergency stop, whatever the value of the 2 ATR was at the time. Now, it's going to change every day, but at the time that I entered, it was down here. So I placed my emergency stop 2 ATRs below. And basically, if I position size correctly, if it does get down to that emergency stop, I will have a 1% total loss of my account. Now, the good news is that only happens about 5% of the time. And the other 95% of the time, if I have a loss, it will be because it triggers my end of bar stop. So my end of bar stop was simply a close below the bullish order block level here at 29.73. So again, had the V1, entered the trade, placed my 2 ATR emergency stop below. I know where my end of day stop is. Now at this point, I always place an orange line above, and you can see here's the orange line. This is exactly 1.5 ATRs above. And this is what's called my trailing stop mode. So if we get into once we get to trailing stop mode, then if I have a close below a previous bar's low, I will exit half. This is a way to reduce my position size, to basically tighten up all my stops. And lastly, the emergency stop, the end of bar stop, the trailing stop level, these are all defensive moves. If they go against me, then I take action. But I also want to have some offensive moves. Just like in any sports team, you need to play offensive and offense and defense. Well, to play offense, I take partial profits if the price moves the value of 0.45 ATRs from the previous bar's close. To give you an example, here we are up here now at 32.02. This is the previous bar's close. The 0.45 value at the moment is 30 cents. So I will add 32.02 and add 30 cents to it. That will be my first profit target on Monday. I'll take my first profit target, add that to it again. That's my second profit target. I'll take my second profit, add the 30 cents to it again. That will be my third. So I always have 3 standing limit orders the next day, just taking the closing price, add the value of the 0.45 to it to get my 3 profit targets. So what that means is if on Monday it moves up at least 30 cents, if it moves up 30 cents, I'll take my first profit target. If it moves 60 seconds, I'll hit my second. If it moves 90 cents, I'll hit my third. So this is a way for me to take advantage of the move up, lock in the profits, reduce my overall position size. And to me, taking partial profits is very important. So let's go back to the trade. So I entered at $30.29. Well, later that day, it did move 30 cents, so I took some profits. Then we kind of gapped up here, didn't do much, came back down, had a gap up here, took some profit targets at profitable levels. Here on the 12th of June, we did get to trailing stop level. So this means now in the future, if I have a close below a previous bar's low, I will take off half of the remaining shares. So we moved down, we didn't have any closes below, we moved up, I took a little profit, moved up again, I took a little profit, moved up again here, took a little profit. On this particular day, we closed below the previous bar's low. after reaching trailing stop level, I did take half of the remaining shares off for a gain of 0.98%. We had a few days of sideways, moved up here, took some more profit targets, and then you can see here on Friday, we broke up above this range here, and I hit a couple profit targets. So this has turned out to be a really good trade. The remaining shares that I have from entry to current price up 5.37%. All right, next trade, XLE. All right, XLE was a simple deep dip buy approach. And the black line here is the 200-day moving average. This is a key level that a lot of institutional and savvy traders key off of. So I did get long here on the 18th of June at $88.63. Why? Because the previous day we closed below the 200, then we moved up. The end of the day, it had tested the 200, stayed above it. Now, the 200 is not a magic line. I mean, it's important because, you know, a lot of traders look at this, and so sometimes it becomes a self-fulfilling prophecy, but it mainly just gives me a good construct for the trade. Above this 200, I'm in. Below the 200, I'm out. So now I have the 200 as support below me. So I did enter here at 88.63. I positioned the size correctly. I placed my emergency stop, of course, 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I place my 1.5 ATR trailing stop level above. Next day moves up, hit some profit targets. Next day down a little bit. Next day moves up again. I hit some more profit targets, and I also got to trailing stop level, which means if I get a close below previous bar's low, I will get out of half the position. This happened here on the 26th, and I can't read this, 2.22%. So I sold half at 2.22, half of my remaining position for a gain of 2.22%, reduced the position size by half. Then we moved up again from here, hit some more profit targets. Friday it was down, but so far a good trade. Remaining shares from entry to current price up 1.65%. Home Depot. Home Depot is a trade that I took on Friday. Also a deep dip buy approach. Again, 200-day moving average here is the black line. We came down into some support here, and during the day we had an intraday rejection of the 200, meaning it went below the 200 during the day, closed above. I got in at 334.53. I placed my 2 ATR emergency stop below. My end of bar stop is simply a close below the 200-day moving average. Even by 1 penny, I'm out. But right now, I have the 200 as support below me. It's a lot better than having the 200 above you as resistance. So I don't know if this is going to hold, obviously. All I know is it gives me a good line in the sand. If it closes below the 200, I'm out. If it stays above the 200 and moves up, well, then I'll hit my, then I have my profit targets to hit. I have my 1.5 ATR trailing stop level here. If it gets there, then I go into trailing stop mode. So, I don't know if the trade's going to work. All I know is the market told me that it rejected the 200. And again, as long as it's above, I'll stay in. If it's below, I get out. And in worst case scenario, I know where I'm going to get out here, 2 ATRs below, and I know my maximum risk. If it gets down here, I'll lose 1% of my account. It's not fun, but it's definitely recoverable. And like I said, that only happens about 5% of the time. So brand new trade, we'll see what happens, but the key is it's a good risk to reward ratio. It closed barely above the 200. So I'm as close, I try to get as close as I can to my end of day stop, which is the 200. And if it just closes 1 penny below, I'm out of the trade. And that I have a plan and that I have a process of how to handle this, whether it goes down or up. So I got in at 334.58, which is exactly where it is right now. So totally even on the trade. All right, UNG. Well, this is a short trade. It's been an excellent, excellent short trade. I kind of saw this trade coming about a week before it happened. If you watch the podcast, you'll understand. But way back here on the 23rd of May, we rejected the 200-day moving average. We got up there, we basically touched it perfectly and moved back down. Why did we move back down? Because there were no more buyers at this level. So then we came back down here strongly. We broke this upward trend line, which turned us into a bearish market structure. And if you go from a bullish market structure to a bearish market structure, then the idea is after that bearish market structure change, you want to short rallies. Well, we definitely did have a rally here, and I shorted here at 2082. Why? Well, we did the previous day we did close above the 200 and then we closed back below the 200. Now the 200 is acting as resistance above me. So I position size correctly, place my 2 ATR emergency stop up here. My end of bar stop is simply a close above the 200. I was very close to the 200. So even if it just moved up a little bit the next day and closed back above, I would exit the trade. I place my 1.5 ATR trailing stop level down here. And then, of course, as it moves down, because it's a short position, I will take partial profits like I always do. So, but the key here on this trade, again, is that we have this huge uptrend here that was broken to the downside. Now, the way that I look at this, it is a bearish market structure. So if you have a bearish market structure, you want to short rallies like I did. If you have a bullish market structure, you want to buy dips like I did on Intel. So this has been a fantastic trade. Like I said, I entered here 2082. We moved down, we moved down, we moved down. I continued to take partial profits as it moved down. We got to trailing stop level, which is the orange line. Then here on the 18th, it closed above a previous bar's high, and I did take half off for a gain of, what is that, 4.78%, but I still kept half. And then you can see we have just moved down. As it moves down more and more, I continue to take more profits. Now we're at a very interesting level right here. We're at 33.29 on the RSI. If it goes under 30 and then back over 30, I'll take another half of everything I have off. After that, if we have a close above a previous bar's high, I will exit the trade as well. Alternatively, right now, if it doesn't go and test the 30 RSI, I have the 5 EMA, which is this blue line here. If at any point next week it closes above that 5 EMA, then I'm simply out of the trade. So I know this may sound complicated, all these rules, but yes, I have rules for everything. I know, and they're there for a reason. They are really there for a reason because, again, like I said at the beginning of the show, you have to have a process. You have to have rule-based process that tells you, regardless of what the market does, you have to have a plan. And so, I do teach private one-on-one lessons in the evening time. And in that course, I do teach you all the rules of all the different strategies that I use. It's a great course. If you're interested, my email is in the link in the description. Just send me an email and we can get the conversation started. But it's a great course, and I will explain all of these rules to you. So this particular trade is a monster. You don't get these type of trades that often, but sometimes you do. This is up 33.3. The remaining shares are up 33.33% on this short position on the remaining shares. So it's been a really, really good trade. DoorDash. All right, DoorDash, also been a nice trade here. This is a long trade. This is a deep dip buy. I did buy this back here on the 1st of July. Why? Well, for multiple reasons, actually. The main reasons is we had a deep dip buy. We had an intraday rejection of the 200-day moving average, meaning that during the day we went below the 200. We closed back above it. Um, the importance here is that there were no more sellers under this 200-day moving average. So I did get long here, 108.41 with the intraday rejection of the 200. But on top of that, if you look big picture on this trade, we had some other things going on as well. Notice the MACD lines here. See the big red bars here? Well, look at this low here, how deep the bars are. Then we come over here on the day that I bought it. We are lower here than we are over here. But look, there was just a little bit of red. Huge red over here, little bit of red over here. So this is one of the reasons that made me take this trade. Yes, we had an intraday rejection of the 200, but we also had a beautiful double bottom bullish divergence. And all this means with this little red over here is this move down here from a MACD perspective had much less momentum to the downside than over here. And really what that means is you're starting to run out of run out of sellers. And if you run out of sellers, the implication is that you're going to go up. So this really was yes, it was a rejection of the 200, but more importantly to me, it was a rejection of the 200-day moving average while you were running out of selling momentum based upon the MACD reading. So that was really what kind of was the last straw for me to take the trade, was that double bottom and bullish MACD divergence. So I entered here 108.41. I placed my two ATR emergency stop, 2 ATRs below. My end of bar stop is simply a close below the 200. And you can see after I took the trade, there were several days, 2 days, where the next day it did test. It went below the 200, but closed back above. That's what kept me in the trade. On Friday, we visited these levels below the 200 again, but still we ran out of, there were no more sellers down there. That's why we moved up. And so we had a nice move up. And I did hit a profit target on this particular day. So I took 10% of the shares that I had, of the remaining shares that I had off. You can see the orange line up here, 1.5 ATR trailing stop level. So it's been a good trade, only been in it for 3 days, but right now, currently up 2.33%. And if I do get to trailing stop level, then I go into trailing stop mode, which means that if I have a close below previous bar's low, I will get out of half the position. So that is DoorDash. And then Tesla has been another monster trade. And, you know, it was such a good and clear setup on this particular trade. It went up so much that it's kind of skewing the charts here. I'm going to move this here so we can see a little better of why I took the trade. But this was a very clear signal called a return to value V2. Sorry, the ratio on here is tough because it's moved these bars up so much. But let me see what's the best way I can explain this. Let me point out the two green lines here, the top green line and the bottom green line. This is the 1 ATR channel. This is the negative 1 ATR channel. Anywhere in between these two green lines is considered the value zone. So the setup for return to value V1 or V2 is as follows. First of all, we need to close above the value zone. Well, this happened back here on the 21st of May. Secondly, we need to come back in the value zone, which we did. Thirdly, we need to go sideways, which we did. And when all three of those have happened, we've closed above the value zone, we've come back into the value zone, we have sideways motion. When all of those are in place, then I can take a V1 or a V2 signal. Well, I took the trade here on the 12th of June with a V2. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. I got in at 177.10. I placed my emergency stop 2 ATRs below, and my end of bar stop is simply a close below halfway of this washout bar. I apologize because I know it's hard to see this because this huge move up here has moved the ratios of the bar. So I know it's difficult to see. And by the way, if you'd like to learn more about V1s or V2s, just go to my YouTube channel. I have a video there in the lessons playlist about V1s, V2s, and I think you get a lot easier look and view of what V1s or V2s are. But I hope you can see this V2 here. Bar 1, bar 2 goes under bar 1's low, bar 3 closes above bar 1's close. Again, emergency stop, 2 ATRs below, end of bar stop, simply a close below halfway of the washout bar, which is very close. Here's my 1.5 ATR trailing stop level, entered here at 177.10. Next day, we moved up strongly. I did take some profits off. We got to trailing stop level, and unfortunately, I had a close below a previous bar's low where I took off half of the position for a gain of 0.35%. But thank goodness I kept, I guess I should have kept it in this view. But good thing I kept the other half of the position because then we had another move up, took some profits, moved sideways, and now we've had this tremendous run up. And of course, I'm scaling out and scaling out and scaling out into this huge move up. We're at 85 RSI level. So right now, a couple different ways for me to completely exit this trade. Here's the 5 EMA because we got to a 65 RSI level. Now that comes into play. If I have a close below this 5 EMA, I'm simply out of the trade. Alternatively, if we reject the 70 RSI, I'll take off half. If I do take off half with the rejection of the 70 RSI, then if I have a close below previous bar's low, then I'll get out of half of the position. But this has been a monster trade. The remaining shares on this particular position, yeah, up 29.5%. So between UNG and Tesla, just monster trades. They don't always happen like this, but I'm glad they did. But sometimes they do happen. All right, so that is Tesla. And then last trade, this one was a losing trade, was INDA. I did get out of that on Friday. You can see this bar up here highlighted in red. This is called an abandoned baby. This one didn't work, but in my opinion, or in my experience, about 70% of the time these work, but this is one of the 30% that it didn't work. Look, we had a gap up, followed by a gap down. When you have a sudden change in sentiment, when you gap up higher and then immediately gap down lower, that's generally a sign that more times than not, when that happens, you look into the future, that market's going to be lower. But this particular time, no. So I did get short here on the 24th of June at 55.13. When I take these trades, it's one of two things are going to happen. I place my stop 2 ATRs above. I place my profit target twice that, 4 ATRs below. I put that trade on, and one of two things are going to happen. I'm going to hit my 2 ATR stop, or if I'm right, I'm going to hit my 4 ATR profit target. Like I said, in my experience, about 70% of the time or a little more, these particular setups work. But the good news about that is 70% of the time, I'm going to be making 4 ATRs profit. Only 30% of the time, I'm going to be losing 2 ATR loss. But this was one of those situations where it did not work. I got out on Friday because it hit my my stop loss, actually a little bit more because it gapped over above, and this was a loss of 2.74%. So those are the dailies. Quick recap: Intel remaining shares up 5.37%. XLE remaining shares up 1.65%. Home Depot, new trade, completely even. UNG, the short, doing very well on the short, up 33.33%. DoorDash, the long, up 2.33%. Tesla, the long remaining shares up 29.5%. And INDA, the short, this was a losing trade, down 2.74%. So those are the dailies. Let's head to the weeklies. Dailies were great, obviously. The dailies were great, but I also like to trade multiple time frames. The weeklies didn't turn out so well, but that's how it goes. Sometimes your weeklies will be doing well, and the dailies will be doing poorly. And that happens, but that's why I like to have multiple time frames because, like I said, sometimes one time frame will be doing well, but the other one won't, and vice versa. So I like to diversify not only in my trading strategies, not only in the markets that I trade, but also in the time frames. So let's head to Meta here. Okay, so Meta, you heard me talk about changing market structure and shorting a rally, and or if you break to the downside into a bearish market structure to short the rally. Well, this is what happened. We did on the big move down here back in April. We had a big move down, which the way that I look at markets, we did change to a bearish market structure. So I want to short the rallies. Well, like I was showing you before on Intel with the bullish order block, this is a bearish order block. This was your highest up close before a change in market structure to the downside. I did get short here on the 7th of June when we came back up into this bearish order block, but didn't work, just continued up. But I did get short here 492.96. I placed my emergency stop 2 ATRs above. I placed my 1.5 ATR trailing stop level below if it went down to get into trailing stop mode. And then, of course, my end of bar stop was simply a close above this order block. So I was in this trade for about 3 weeks here, and it just stayed inside this order block. But Friday, of course, we had the big up day, and we did close above that order block. So I did have to get out of the trade for a loss of 8.70%, which was a bummer. But listen, we're going to have a lot of trades that don't work as well, right? But again, the 2 ATR emergency stop up here, even if I got to there, we didn't get to there, but even if I got to there still, how much would it really of my total account would I have lost? Only 1%. So right here, this looks like this was about 0.6% total account loss on this particular trade. But, you know, strange market. More times than not, when you got into this level here, you would have moved back down, but we just didn't. But so this lost 8.7%. VIX on the weekly. All right, I did take VIX on the weekly back here on the 14th of June. Why? Was a deep dip buy. We had during the week, we went under the 30 RSI and then closed above the 30 RSI. We also created a V1. Here is bar 1, here is bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I got long at 11.21. I position size, I placed my emergency stop 2 ATRs below, as always. My end of bar stop was simply a close below the 30 RSI because the main reason I got into this trade was a rejection of the 30 RSI. So therefore, in the future, if it closed below the 30 RSI, I would get out of the trade. And so really never had a chance. Next week went up a little bit, but this Friday we did close at 28.69, which is definitely under the 30 RSI. So I had to get out of the trade for a loss of 6.88%. So not so hot tamale on the weeklies, but the key is I took the trade. The trade was a legitimate trade. It just didn't happen to work out. So I'm out. Look, I can get back in VIX again if I want, simply if it closes back above the 30 RSI. So it's important that you stay true to yourself. You create that plan. You know your levels. And if it goes against you, just get the heck out, right? You can always get back in. Okay, last trade on weeklies is IBB. Similar to Facebook, We have a bearish order block here. We have the highest up close before the market structure change. I did get short here back on the 15th of May at 136.69. One, because we got into the bearish order block. Two, because we rejected the 200-week moving average, similar as on UNG, on the natural gas trade. So I placed my two ATR emergency stop above. My end of bar stop is simply a close above this 200-week. Next week, went above, closed below, kept me in. Then we had to move down, which luckily I took some profits, right? Came back up, went above the 200, but closed below, kept me in. Next week, went above the 200, closed below. Next week, tried above the 200, closed below. The week before last, we went way up, closed below. That kept me in the trade. And then this week, again, we tried to get above the 200 and close below. So this particular trade up 0.39%. Not up a lot, but up. But the key is, do you see how every time we've gotten above the 200-week moving average, there have been sellers there? So that's telling. Okay, so recap on the weekly. Meta down 8.7%, VIX down 6.88%, and IBB up 0.39%. So you can see not all great trades on the weekly. On the daily, they were great. Overall, it was a really, really good week. It's just important that you create that plan, follow that plan. Sometimes you're going to have huge, great outsized winners, but the key is position size and create the trade and the structure of the trade. So if you're right, you can be right big. You have the potential to be right big, but if you're wrong, you can be wrong small. And that's the math of trading. Large wins are fine, obviously. Small wins are fine. Break-even trades are fine. Small losses are fine. What you really have to keep yourself away from are those big losses. Okay, so listen, before we start taking a look at the potential trades for next week, let's talk a little bit about trader psychology. This is from Stephen Goldstein. You can follow Stephen at AlphaMind101 over on Twitter. Stephen is a world famous trading coach, mental trading coach, retired trader, and just great guy, author, great podcast. He interviews all sorts of different traders from around the world. I was fortunate enough to be interviewed on his podcast a couple times. But I think this is a really, really great post. And again, we're talking about trading psychology. So this is definitely trading psychology. So your ego's need to be right conflicts with the market proving you wrong often. Let's read that again. Your ego's need to be right conflicts with the market proving you wrong. So there's two different things going on here. Your ego, it wants to be right, but if you think the market's going to do one thing, but it's doing another, there's going to be the conflict. So the ego's need to be right conflicts with the market's proving you wrong often. This internal clash sparks powerful internal feelings which leave you sad, bitter, angry, and vengeful. These feelings can take you away from your process, make effective action difficult, corrupt your ability to see things objectively, unbalance you, cause you to fail. Within that lies the heart of your trading challenge. So it all comes back to ego. One of the ways to not get your ego involved in trading, and you can see your ego is responsible for it ultimately is responsible for taking you away from your process, making effective actions difficult, corrupt your ability to see things objectively, unbalance you, cause you to fail. Your ego. So if we can get rid of the ego, then we can stay away from all these issues. How do you do that? Folks, the best way to do that is to not have a theory or an idea or a bias of what the market's doing. We fall into that trap where we go, oh, the market shouldn't be doing this, or it should be doing this. If you think the market should be doing this or that and it doesn't, then these things can happen. The best way, and that's why I'm a technical trader, just don't worry about what the market's doing. Just look at your technicals and go, hey, if it goes up or if it goes down and rejects that 200-day moving average, hey, I may take a shot at that trade because the market told me it didn't like there were no more sellers under that 200. Regardless of what the media is telling, regardless of what you're losing. I mean, look, we are in, in a handful of stocks and I think we can all kind of consider a bubble. Straight up, relentless, straight up, 5, 6, 7 stocks. With the rest of the market going down, right? Nike, Disney, all these type of stocks, they are just at the bottom basement right now with a handful of stocks going up. You can say, hey, this is dumb. This is ridiculous. This shouldn't happen. I'm going to start shorting up here. Well, shorts have just been steamrolled, right? And if it keeps going up, the higher it goes, the more you think you should short. The key is forget about what the market's doing. The market's going to do what the market does. It doesn't care about you. It doesn't care about your short position. If it keeps going down, the market doesn't care. It doesn't care about your long position. The best thing to do is just not have a bias about the market, not have a bias, not have opinion, and just go off of the technicals. And if you can get to that point in your mind, then everything becomes easier. Then you can, if you get rid of that ego, then you can get back into your process. You can have effective action. You can start seeing things objectively. You can become more balanced, and you can start to succeed. So the main thing is the ego. And your ego comes into play if you get a bias or an opinion. Just don't get rid of your biases and opinions and just trade the market that's in front of you and just trade the technical. So thank you, Stephen Goldstein. Do yourself a favor. Subscribe to Stephen at AlphaMind 101. Listen to his podcast. I think you'll learn a lot. All right. So let's get to the potential trades for next week. Now, I always start this off by saying, look, here I have 7 dailies potentials for next week. Now, next week, these could all happen at the same time. Does that mean I'm going to take all of them if they trigger the same day? No. I have a policy where I only take the best trade of that particular day, even if 5, 6, 7 of them trigger. Well, how do I know which one's the best one? It's like a report card. It's like a scorecard. Which one had the most confluence of signals? Which one had the best or the worst market relative strength? Which one had the best risk to reward ratio? Which one looked better on multiple time frames? The devil's in the details. That is how I come up with the best one. Which one had the best report card? That's the one that I'm going to pick for that particular day. And again, this is what I teach in my one-on-one course. I teach all my students this, how to narrow down to the very, very best trade. All right. Okay, here we go. Let's start off with Alibaba. Alibaba has the potential for a higher low V2. And last week, during the week, I try to do about a 10-minute video every day of some of the day trades that I have taken. And last week, I had a lot of higher low V1s or V2s. Well, this is setting up and formatting right now for a higher low V2. So let me show you the value zone here. Top green line, bottom green line. First requirement is that we close below the bottom green line, which we did. Second, we need to come back into the value zone, which we did. Third, we need to pull back, which we did. So this trade is valid only for Monday. We have potential for a V2, bar 1, bar 2. Bar 2 goes below bar 1's low. We also pretty much tag the -1 ATR channel, which is good. So on Monday, if Alibaba can get to 75.57, I don't know if it will or not, but if it does, we will have a higher low V2, which is a higher low anything is better. Higher low V1, V2, higher low rejection of the 200-day moving average, higher low under 30 over 30. Higher lows are always better if you want to get long. In addition, if we do come up and we do get to 75.57 and create that higher low V2, we'll also be above the 200-day moving average, which would also be a plus. So again, for me, this is only for Monday. If you get above 75.57, have a higher low V2 in the value zone, MACD is green, that would be a good potential entry right there on Alibaba. Caterpillar, same potential higher low V2. We closed below the value zone. We moved into the value zone. We've had a pullback. On Caterpillar, if we can get above 330.61, then we will have another higher low V2 in the value zone. MACD is also green as well. But again, both on Alibaba, for me, this is only for Monday. If it doesn't get above there Monday, then the trade's gone. So Alibaba above 75.57, Caterpillar above 330.61. Walt Disney. I was just talking about Walt Disney. So Walt Disney is interesting. Walt Disney is definitely out of favor. I don't think they're going out of business anytime soon. But first of all, let me show you the double bottom and the double bottom bullish divergence. Look at these lows over here. Deep red MACD bars, certainly. Then we rallied, got some green. Now we are much lower over here than we are over here, but do you see the red bars here are much less deep than they are over here? That means from a MACD momentum standpoint, we're running out of momentum. We're running out of sellers. If you run out of sellers, again, the implication is you're going to go up. So a couple things here, either to the upside or the downside. One, if we got above the 200-day moving average, I would consider getting in the trade because that's a close under, close over the 200. That would be one potential for next week. Ideally, I'd like it to come down lower. Here's the 250-day moving average. Here's the 300-day moving average. Okay, this is full on deep dip buy right here, right? And this is a total deep dip buy type of trade. But confluences are always important. And right now we're at a 33.03. So what that means is that the 30 RSI is coming into view. 30 RSI just by itself is a legitimate deep dip buy, but if you can have a rejection of the 30 RSI at the same time you're at one of the major moving averages, that's even better. Remember, I was talking about a scorecard looking for confluences, combinations. Right here, the 250 is at 96.37. The 300 is at 95.32. Down in this area would be a really good confluence, especially, I mean, that 250 dovetails with the negative third ATR channel, and we'd be about 30 RSI. So couple options on Disney, and I really like the potential for Disney here. I really do, but I still need to have the trigger. So either a close back above the 200, that would be legit, but ideally I'd like it to come down here, reject the 30 RSI, reject the 250-day moving average or the 300-day moving average. That would be the sweet spot for me right there. So I'll be watching Disney closely next week. FXY. All right, so this is the Japanese yen. You can see I highlighted the green box here. Why? Well, this is an island reversal. What's an island reversal? Here, on the 28th, we gapped down. Then we moved sideways. On Friday, we gapped up, leaving these three bars here in what's called an island reversal. We went down, sideways, out of nowhere, we kind of gapped up. This looks good to me. This looks like a bottom to me, but I still need a signal. I could honestly have taken the signal on Friday with the island reversal, but what I'm looking for is that on Friday, we close back above the 30 RSI. We're 32.82. So the previous day, we were below the 30. We closed above the 30. That's legitimate. But I was talking about higher lows. If next week we can come back down a little bit, close back under the 30 RSI, and then in the future close back above the 30 RSI, we would have a higher low under 30 over 30. Here, we went under 30 over 30, yes, but we did it from a lower low. If next week we can go back down under the 30 and then back above the 30 again, it would be a higher low. I on the day trade video that I put out yesterday, this is exactly the trade that I had on WBA. It went under 30 over 30, and then went back under 30, and then went back over 30. So a higher low under 30 over 30. And it turned out to be a great trade. And so this is what I'm looking for on FXY. It may just take off from here. That's fine. But next week, if it closes under 30 and then again closes over 30, to me, very good indication that that's probably a short-term bottom for FXY. Russell 2000. Okay, another potential higher low V2. We closed below the value zone. We moved into the value zone. We've pulled back. And so Monday only, if we close above 201.83, that will give us a higher low V2 in the value zone while MACD is green. Netflix. Okay, so Netflix looking for a potential short here. Notice the high here. Notice the high here. I draw this line out. This is a channel. If next week we move into this channel, very likely that will be a short-term top. And the reason why I'm telling you this is I've been talking about double bottoms, bullish divergences. Let's talk about bearish divergences. Here we have a high with high MACD bars, tall MACD bars. Then we pull back. We go higher. We're higher here than here, but you see how the green is lower than over here? This means we're running out of sellers. Now, we're just about as high as over here, no green bars whatsoever. So this is called, at this point, it would be called a triple top with bearish divergences. We're going higher and higher, and if we get up higher here, we don't even have any green now here. So this to me looks very, very toppy. And but what I would be waiting for would be a rejection of this trend line or this channel line up here. If we reject that and we have the bearish divergences, to me that would indicate most likely we have a short-term top there. And if it rejected that, then the high of that rejection, that would just be my end of day stop. So I'm looking for a short on Netflix if we reject that trend line. And then RIO. Okay, I really like this trade, by the way. This is Rio. You can see this highlighted bar here. What's this? This is an abandoned baby. We gapped down, immediately had a huge gap up. See how it leaves it down here by itself? That's why they call it an abandoned baby. Gap down, gapped up. Now, I didn't buy this gap up because it was so far up here that the risk to reward wasn't very good. Let me bring your attention to this trend line. See the trend line here, the high here, down here. See how we broke the trend line to the upside? A lot of times when you break a trend line to the upside, it will come and back test the trend line before it moves up strongly. Well, the high of this abandoned baby here would be a very, very interesting spot to buy. When I have abandoned babies, I like to buy them when they pull back and close the gap. If we close the gap here, one, we're closing the gap. Two, we would come back and test this trend line. So I would be very interested in buying RIO if we could come back to about 66.06. So it's about $1.60 below us. We've also changed market structure. To me, this looks like we're in a bullish market structure now. We had a low, lower low, we broke structure. This changed everything. So now, if we change to the upside, I want to be looking to buy. So really, technically, anywhere in about this location, I'm going to highlight this green, anywhere in this location would definitely, to me, be a buyable area. But the ideal spot would be the 66.06 if it could close the gap, retest that trend line. All right, so that's what we have on the dailies. And then let's go to the weeklies. And again, same thing with weeklies, everybody. These could all trigger next week on Friday because that's when weekly bars close, but I'm only going to take the very, very best one. Okay, Carnival. All right, so these are weekly bars. Okay, so not this last week, but the week before that, we moved up strongly above the 200-day moving average. Is that legitimate buy? Technically, but the risk to reward's horrible. But now this week we moved down significantly, down 8.07%. What I'm looking for next week is a rejection of this 200-week moving average, meaning we go back down, we bounce, or we go under and close back above, giving me a better risk to reward ratio. That would make sense to me as a place to buy. But you understand why I didn't buy it last week. Yes, it closed under and closed over the 200, but just not going to buy that. The risk to reward ratios. I mean, I could have bought it here on Friday. Risk to reward ratio is a lot better than the previous close, right? But I'd really like to see it come down and test that 200, giving me a better risk to reward ratio. But I like that potential trade if it rejects the 200 next week. CRM, Salesforce. Okay, well, you can see there's a highlighted red box here. That means that's a shortable area for me. This is the highest up close before huge move to the downside. So if we've changed market structure to the downside, I want to short rallies. Well, the ideal spot for me in this red box here would be about 278. That's halfway of this bar, big bar down on May 24th. If you go back into a big down bar halfway, you'll have inherent resistance there. Not all the time, but many times you'll have inherent resistance there. And that also dovetails of being inside of this bearish order block. So next week, if we can reject the 278 level, then I will definitely consider getting short. My stop would be a close above that bearish order block. Russell 2000, I've been talking about this for several weeks here, but I'm looking for a move down to the 200 and rejection of the 200-week moving average. You can see we rejected it over here with a good risk to reward ratio, what it turned out to be a good trade. Now we've come back down. The Russell's struggling, but next week and only next week, if we reject the 200-week moving average, that would be my spot. But if and only if. McDonald's. I like McDonald's. Again, look at the tale of two different cities in this market. Apple, Google, Facebook, Amazon, straight up. The more traditional legacy companies, straight down. Interesting times, everyone. Interesting times. But this move down on McDonald's, I think, gives an opportunity. This 200-day moving average, we're at a 35 RSI. We're in the low 35s, or we're in the low 30 RSIs, and we're getting close to a 200-week moving average. That's a great confluence. So next week, if we can reject that 200-week moving average, it doesn't mean it's going to be a winning trade for me. It just means that it gives me very good structure. One, we're at a key level on the moving averages. Two, we're at a key level on the RSIs. Three, if it goes down and rejects the 200, the market's telling me there were not any more sellers under the 200. And four, if it does that, it gives me a good risk to reward ratio. Again, all this doesn't mean it's going to be a winning trade, but it means that I'm stacking the deck in my favor. And if I'm wrong, and it closes below the 200, I just get out. But if it stays above the 200 and starts moving up, then I have the potential for a really good trade. So it's all about having that line in the sand, and that 200 would be the line in the sand, but I first want to see it rejected. Pfizer. Okay, green box means something bullish going on. This was your lowest close before you had a change in market structure. This was your change in market structure. If you have a change in market structure to the upside, the way that I look at it, want to buy dips. I want to see it just like on Intel. This looks almost exactly like Intel, right? We have a low, we have a rally, we have a lower low, we change market structure. And I said on Intel, if it gets back down into that green area, that would be the place to buy. Well, we're not there yet. But if we do get down into this green area somewhere between about 2637, 2467, this would be the buyable area for me. My stop would simply be a close below that bullish order block. And then last but not least is XLU. XLU had a huge move up, got into the 70 RSIs, got overbought over here. Now we're simply just coming back down. But if you're in an uptrend, which of course this is an uptrend, I want to be looking to buy the dips. Well, that 200 week moving average in the value zone would be an excellent place if it rejects the 200-day moving average. And again, it doesn't mean it's going to be a winning trade. It just means that the spot that it's in, the zone that it's in, would make sense. Have a big move up, come back down in the value zone, which is a good place to buy anyway. And then that 200-week moving average just gives you that line in the sand. All right. So, hey, I mentioned a couple times during the podcast, but I really do think it's important. If you would like to learn to trade better, if you would like to learn to trade all the different strategies that I use, I've been trading for over 28 years now. I've been through every single market. If you would like to learn to trade better, if you'd like to learn to get a trading process where all these rules, there's a real reason for these rules and they're important, consider hiring me as your trading coach. I have a really great course, 15 hours, where I teach you step by step all the different trading approaches that I use. You're going to know these like the back of your hand when we're finished. And the best way to learn anything is one-on-one with your instructor and your coach. And in this course, I teach you all the different strategies. But not only do I teach you, I then make you prove to me that you know them. We do all sorts of simulation trades. We pick random markets. We pick random time frames. We go through them bar by bar. And you're the one telling me, okay, we get in here. This is what we're doing now. This is what we're doing after that. And if you're right, I say that's exactly right. And if you're wrong, I say no because of this, that, or the other. But I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. And they've all become better traders. And I know I can make you a better trader too. So if you're interested, just send me an email. The course costs $1,750. It's an investment. I realize that, but it really is an investment for you to use the skill that you can use the rest of your life. Alternatively, if you're not in a financial position for that, I have a really good, very affordable alternative. I have a really good video course on udemy.com, and the link's in the description, where I teach you step by step how to trade the deep dip buy stock trading strategy. Not all the other strategies, but in that particular video course, it's just the deep dip buy strategy, but it's very affordable. I think it's about $40, and there's 9.5 hours of content in there, and that's a really good place to start. So either way, either of those options give you a good chance to improve your trading. All right. So I appreciate you being here, everyone. If you have any comments or questions from the podcast today, please put them in the comment section. I'll do my best to answer them, but I always like to leave off with, please try to go out and do something nice for someone today. Really would make the world a better place. Additionally, if you could go out and do something nice for an animal today, I would really appreciate that. I grew up with a lot of animals, and they appreciate acts of kindness just like we do, and if we could do one nice thing for a human, one nice thing for an animal, it would just make the world a better place in general. And I think we could definitely use that. So I really appreciate you being here, everyone. If you liked it and found anything of value today, if you could hit the thumbs up button, I would certainly appreciate it. But enjoy your week, and God willing, I will see you next week. But please be careful this week. Get yourself a process, follow your process, get that ego out of the way. All right, take care, everyone. Thank you. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.